Welcome to Narvi Academy. In this presentation, I am going to discuss about Reserve Bank of India. Reserve Bank of India or RBI is the central banking institution of India. Let's discuss the establishment of RBI. The Reserve Bank of India was established on April 1st, 1935 in accordance with the provisions of the RBI Act 1934. This act provides a framework for the supervision of banking system in India. The RBI was nationalized on January 1st, 1949, and after the nationalization of RBI, it is entirely owned by the Government of India. But before the nationalization of the RBI, it was entirely owned by the private shareholders. Let's see the headquarters of the RBI. The central office of the RBI was initially established in Kolkata but was permanently moved to Mumbai in 1937. The RBI also has 4 local offices at Mumbai, Kolkata, Chennai, and the New Delhi, and 27 regional offices, most of them in the state capitals. And these local and regional offices are for advise the central board on local matters and they represent territorial and economic interests of local, cooperative and indigenous banks. Now let's discuss about Indian currency. RBI issue the Indian rupee notes except 1 rupee note. According to the RBI Act 1934, the RBI can issue the Indian rupee notes of rupee 2 and all the notes greater than rupee 2, and maximum it can issue the note of rupees 10,000. The RBI notes printing presses are situated in the Indian cities Mysore, Salbani, Devas and Nashik. The Government of India issue the 1 rupee note and all the coins. According to the Coinage Act 2011, the Government of India can issue a maximum 1000 rupee coin. The mints of the Government of India are situated in the Indian cities Mumbai, Kolkata, Hyderabad and Noida. Now let's see the preamble of RBI. The preamble of RBI is to regulate the issue of bank notes and keeping of reserves with a view to securing monetary policy in India and generally to operate the currency and credit system of the country to its advantage, to have a modern monetary policy framework to meet the challenge of an increasingly complex economy, to maintain price stability while keeping in mind the objective of growth. Now let's see the central board of the RBI. The Reserve Bank's affairs are governed by a central board of directors. The board is appointed by the Government of India according to the RBI Act. The board is appointed for a period of 4 years. There are 1 governor and maximum of 4 deputy governors appointed as official directors, and there are 10 directors from various fields, 2 government officials and 4 directors for local boards, 1 for each. Now let's see the objectives of the RBI. RBI regulate and supervise the financial and payment system in India. RBI ensures the financial stability in the banking system in India. RBI manages the foreign exchange in India. RBI issue the currency in India and destroys the currency if not fit for circulation. Now let's discuss the policy rates and reserve ratios. Let's discuss the repo rate. The rate at which the RBI lends money to the commercial banks against the government securities is called repo rate. Whenever banks face a shortage of funds, they can borrow from the RBI as per the repo rate and against the pledge of government securities. In this case, the commercial banks borrow money from the RBI by selling the securities and bonds with an agreement to repurchase the securities on a certain date at a predetermined price. As the repo rate is the short form of repurchase rate, it is always higher than the reverse repo rate. Mostly it is used to control inflation, and generally these type of loans are for short durations from 2 days to 90 days. Let's take an example. If the repo rate is 6% and any bank borrows rupees 1000 from the RBI, the bank will pay rupees 60 as interest to the RBI. Now let's discuss the reverse repo rate. The rate at which the RBI borrows money from the commercial banks is called reverse repo rate. It is just opposite to the repo rate. Whenever banks have surplus funds but don't have any other lending or investment options, they can deposit the surplus funds to the RBI and earn interest as per the reverse repo rate. Mostly it is used to control the money supply. Let's take an example. If the reverse repo rate is 5% and any bank deposits rupees 1000 to the RBI, the bank will earn rupees 50 as interest from the RBI. Now let's discuss the bank rate. It is the rate of interest charged by the central bank on the loans they have extended to commercial banks. It is similar to the repo rate, but in this case, there is no repurchasing agreement signed and no security is sold. Bank rate is usually higher than the repo rate as it is an important tool to control liquidity. If bank rate is increased by the RBI, the borrowing costs of the banks increase, which in return reduce the supply of the money in the market. And if the bank rate is decreased by the RBI, the borrowing costs of the banks decreased, which in return increase the supply of the money in the market. Generally, these type of loans are for long durations from 90 days to 1 year. Now let's discuss the cash reserve ratio or CRR. It is the fund that banks have to maintain with the RBI at all times. In other words, banks have to maintain a certain percentage of funds of the total deposits in the current account with the RBI. RBI uses the CRR to drain out the excessive money from the system. Banks don't earn interest on this money. Let's take an example. If a person deposits rupees 1000 in a bank and if the prevailing CRR is 5%, then the bank has to deposit rupees 50 in the current account of RBI and the bank is left with 950 rupees. The bank cannot use that deposited amount rupees 50 to the RBI for its commercial purposes. Let's understand through the picture. Here you can see a person or customer deposited rupees 1000 to the bank and the bank deposited 50 rupee, the 5% of 1000 at CRR to the current account of RBI. Now let's discuss statutory liquidity ratio or SLR. Apart from the CRR, the banks have to maintain a percentage of their deposits as liquid assets in the form of gold, cash, and approved securities from the central government or state governments of India. This percentage is known as SLR. Here, banks earn interest on liquid assets. Let's take an example. If a person deposits rupees 1000 in a bank and if the prevailing SLR is 20%, then the bank has to maintain liquid assets of rupees 200 in the form of gold, cash, and as the government approved securities. Let's understand through the picture. Here you can see a person or customer deposited 1000 rupees to the bank, and bank has to maintain 20% of 1000, means 200 rupees as SLR with the RBI in the form of gold, cash and as the government approved securities. Now let's discuss marginal cost of funds based lending rate or MCLR. It is the rate of interest at which the banks lend money to its customers. The lending rates under MCLR are different for loans with different tenors. The MCLR replaced the base rate system with effect from April 1st, 2016. Usually, the MCLR is revised every month. Under the MCLR, calculation of interest rates will be based upon the marginal cost of funds, negative carry on account of CRR, operation costs of banks, and tenor premium. Let's discuss one by one the marginal cost of funds. The amount deposited by the customers vary day by day, so the interest amount being paid by the banks also vary according to the amount deposited by the customers. In other words, the interest being paid on the deposits today may not be the same for tomorrow. Because of tomorrow, customers will deposit a new amount and the bank will have to pay a new cost for that. So the cost for the fresh fund paid by the bank is the marginal cost of the fund. Now let's see the negative carry on account of CRR. Banks lost the earning opportunity on the amount of CRR and SLR, so this loss of earning, banks try to recover through the MCLR. The higher CRR and SLR will increase the MCLR. Now let's see the operation costs of banks. It is the cost required for running the bank, and tenor premium. It is the cost of risk charged by the banks from the borrower for the risk associated with lending for long period. The longer the tenor, the higher the risk and higher the tenor premium. That's it for now. We will come back in the next video with the different topic. Till then, keep watching the Narvi Academy.